Hello and welcome back to the complete day trading course by Wealthy Education. In this video, I'm going to talk about how to avoid blowing up your account. So, one of the biggest problems that I see consistently from traders is they get into the market and they have dreams of being rich. And yes, we do this for money. But we have to keep everything in perspective. So, and a lot of this comes down to marketing. You see marketing materials, they'll say, hey, I can teach you to day trade and I can take that $1,000 and you'll have $100,000 in no time, and they show pictures of people flying on corporate jets and all of this other stuff. Well, that's not the reality of trading. The reality of trading is it's a slow and steady process. You're going to have days where you lose money, not trades, but days, weeks where you lose money. But at the end, what you're trying to do is make more than you lose. And then over time, everything compounds and it becomes a serious business. And that's the biggest problem that I see with people trading. So let's take a stock here and let's just say we're trading US Steel. That's our favorite stock. And it is trading at $10 and it makes a move to $9.90. We bought it. It's gone against us. Well, one stock, and I'm not including transaction fees for simplicity here. If we owned one stock, it cost us 10 cents. Well, what happens if we own 100? Now we're down $10. How about 1,000? Well, now we're down $100 and so on. And unfortunately, what happens is a lot of amateur and beginning traders look at this and go, well, look, if it went up a dime at 1,000 shares, I could be up $100. And that's true. But you're going to have the losses, and the losses, for some unknown reason, always seem to come when you're the greediest. So let's take this $100 loss, and we're now down to $900 from the original 1,000. Well, what was a 10% loss now is going to take basically an 11% gain to turn things around, because 10% of 900 is $90. So you're going to need to gain 11%. And that's where risk and money management skills are so crucial. You don't want to lever up the trade. You want to be as cautious as possible. As a professional trader, your number one responsibility is to protect your trading capital. That means some days you just don't trade. But even if you do and you lose, you take small, manageable losses. A lot of professional traders will risk 1% of their total account per trade. And if your account isn't big enough to do a 1% trade and have it meaningful, then you probably don't have a big enough account. That's just the reality. Some traders will double up on a very good setup. So, for example, this is a nice ascending triangle and an uptrend. We came back, tested that. They may risk 2%. They put their stop loss wherever they need to. They measure at 2%. And that's called going in a little heavier when the setup's a little better. So that's one way you can supercharge your losses, because even then, a 2% loss isn't catastrophic. A 2% loss on $1,000 account is $20. It's not the end of the world. I mean, you don't want to look at every trade like that, obviously, but it is manageable. Trading psychology is crucial. I cannot stress this enough. You must simply be willing to enjoy the process, because if you are just looking to make money, you don't need to trade it. You could have other people do it for you and you don't even have to worry about it. If you enjoy the process like I do, then you learn to enjoy the entire process. Even when you're losing money, you enjoy the challenge of it The money almost becomes secondary, because if you hang on to the profit and loss too tightly with your mental capital, and that is something that you will spend way too much of your mental capital, this can become a very exhausting game. You can get something that's called a margin call if you have things levered up too much. So for example, whatever your broker offers, say it's 5-to-1 or something. So your $1,000 can buy $5,000 worth of stock. Well, there comes a certain point, and it's going to be a little bit different with where your locations and stuff, but there's some certain point where that margin that you put up the $1,000 isn't enough to protect the position, and they will liquidate you, and it'll blow up your account. And that is the absolute worst feeling. Many traders have done that and then have come back to be successful. It's not the end of the world, but it is the end of your live trading for a while. This is why you paper trade. This is why you use low margin. This is why you use low risk strategies in the form of money management, risking 1%, 2%, 3%, whatever it is. This is why you do that, because markets can move in very erratic manners based upon things that there's just no way to see. I mean, look at how loved Apple had been 2013, 2015. And then, I mean, that's a pretty big drop there from 135 to 90, If you're long of this, heavily levered, meaning that you're borrowing shares to buy with your $1,000, it's not going to take long before those losses are worth more than your account, and then you're done. There is no more trading. If you build up over time, you can eventually get this to be a sustainable and large account. If you already have a large account, then you definitely need to protect your money anyway, because volatility comes and goes, and we have events where you can get stopped out all of a sudden for no apparent reason. But if you're down 1% or 2%, it's not the end of the world. You recognize that you were wrong in your analysis, and maybe it's time to reevaluate the entire market, be it Apple or, it could be commodities, it could be Forex. It doesn't really matter what it is. It applies to all markets. You do not want to revenge trade. That's the quickest way to lose money. Because what will happen is, you go long here, and then the market goes against you. You end up getting stopped out. You get angry, so you short it, and then it goes against you again. Happens quite frequently, and it's a great way to pile up the losses from 1% or 2% to all of a sudden 10% by the end of the day. And then you're spending several days trying to get that back. There are different ways to handle this, but I know some traders that once they have a loss, they make it I can't trade for an hour rule, and they just won't trade for an hour regardless of what they see. This is about your own psychology, so it's going to be a little bit personal for each of you, but just understand the dangers of over trading. Looking for the right setup can get you all the profits you need for the day in one trade. You don't need to trade 14 trades. If you're really wanting to hyper trade, then go to the paper trading account. That will save you a ton of money. Maybe you'll learn something new there. That's not a bad thing either. But by all means, do not risk too much on any one particular trade. That's it for Module 1. In the next video, we'll start Module 2.